All right, today we're diving into a huge shift happening in Japan's economy and, more importantly, what it means for the real estate landscape. It's a fascinating story about how a couple of decisions made way up high can really change things for everyone on the ground.
Sounds a little dramatic, right? How can just two people shake up an entire market? But believe me, a recent government move has sent these massive ripples out, and we're gonna break down exactly why. Okay, so here's where it all kicks off. February 25th, 2026. The government puts forward two new names for the Bank of Japan's policy board, and this is a really powerful group. This one move is what started the whole chain reaction. So who are the new members? We've got Professor Emeritus Toku Asada and Professor Iono Sato, but their names are less important than what they believe, and they share a big idea. They're all about the government actively spending money and keeping interest rates low to get the economy humming. So this isn't just swapping out a couple of people, no way. It's a signal of a major shift toward a pro-growth strategy. And this really lays it out clearly, right? You can see the shift in thinking at the very top. We're moving away from what you'd call a hawkish view, the folks who are keen on raising interest rates, to a much more dovish one, which is all about keeping that economic stimulus flowing. So you make a change like this. What happens next? How did the financial markets react? Well, they didn't waste any time. The reaction was fast, and it was big. Let's take a look. First off, the Nikkei stock index just shot up to a record high. Why? Well, investors saw these pro-growth policies and thought, hey, this is going to be great for company profits. But at the exact same time, the yen got weaker against the dollar. That's because the idea of Japan raising interest rates anytime soon, which would make the yen stronger, suddenly seemed a whole lot less likely. And that's really the key takeaway right there. The market looked at this and basically said, okay, interest rate hikes are off the table for now. That one thought drove the entire initial reaction. But, and this is a big but, that's just the first piece of the puzzle. What's really fascinating is that these appointments basically shine a huge spotlight on this deep conflict, this tug-of-war that's pulling the Bank of Japan in two completely different directions at once. So on one side of the rope, you've got the Japanese government, the Takaichi administration. They're looking at homeowners with loans at local businesses, and they're saying, whoa, let's not raise rates too quickly. But on the other side, you've got international pressure, especially from the US, saying, hey, you need to raise rates to make the yen stronger. And the Bank of Japan, they're stuck right in the middle. And make no mistake, this is not just some temporary thing. We're looking at the start of a much longer power shift. I mean, look at this timeline. You can see that two more of those hawkish members are out in July 2027, and then boom, April 2028, the governor and deputy governors, the top brass, are all being replaced. This is all building up to what some people are calling a potential regime change 2.0. Okay, so that's the high-level politics and economics. But what we really want to know is, what does all this mean for the actual real estate market on the ground? Let's connect those dots. What we end up with is this really interesting mix. You've got the brakes being tapped on interest rate hikes, but the accelerator is being pushed on government spending. This creates a market full of these opposing forces, pulling in different directions. And it completely changes the real estate equation, both for today and for the future. All right, let's unpack this a bit. First up, interest rates. For anyone on a variable rate loan, things look pretty stable in the short term, maybe a slow rise. That helps keep property prices up for now. But if you're looking at a fixed rate, well, there's already upward pressure there because of worries about inflation down the line. Then you've got construction costs. They're high and staying high. The weak yen means imported materials cost a fortune. Plus, there's a labor shortage that's only getting worse with all these new government projects. See what I mean? It's like all these forces are pushing and pulling against each other. So all these conflicting pressures, they're essentially redrawing the real estate map of Japan. And it's creating this really clear, really important split. It's really becoming a tale of two markets. First, you've got the prime city centers. Think Tokyo, Osaka. They're actually benefiting from all the government spending. And because they're so in demand, they can raise rents to cover inflation. Property values there, they're likely to stay strong. But then you have the second market, the regional and suburban areas. They're getting hit with all those rising costs, but they just don't have the power to jack up rents in the same way. For them, profit margins are really going to feel the squeeze. So if there's one thing you take away from all this, it's this. The good old days of predictable, super low interest rates, they're over. The new name of the game, the biggest risk in the market now, is just plain uncertainty. With the Bank of Japan caught in that tug-of-war we talked about, trying to guess where interest rates are headed has become almost impossible. And that leaves us with a really important question to think about. In this new, unpredictable world, where a prime location might be able to ride out the storm but other areas can't, is it possible that where you invest is now way more important than when you invest?
Hey, if you found this breakdown helpful for understanding what's going on, do me a favor and hit that like button. And be sure to subscribe for more explainers where we connect these big policy decisions to what's actually happening in the real world. Thanks so much for watching.